Welcome to this session in which we pick up on a few things which are changing in UK GAAP that aren't the triennial review. Obviously there isn't very much that changes in UK GAAP that isn't the FRS 102 triennial review, because the standard setter's intention all along was that there wouldn't be little separate piecemeal changes, that there'd be some sort of periodic amendment so you'd always know where you are. So these were separate issues that simply couldn't wait till the next periodic review, or were dealt with separately in a standard. Now, I'm not really here to talk about multi-employer defined benefit pension schemes, although I am talking about them now, clearly. This is not in the notes, but it's just a quick refresher for you that there was a change back in 2019. We actually did cover this as an exposure draft in the second quarter. Actually, this was finalised about the time that I recorded it, so it's all done and dusted. What this deals with is the scenario where you have an employer that previously has not been notified what their share of the pension scheme's deficit is by the actuaries. Historically, this was pretty common. Generally, they either didn't know at all, or there was a deficit reduction strategy in place, whereby there were payment plans and individual payment schedules were allocated to individual employers. And what you did under FRS 102 is roll up those payments, discount them, and then put them on the balance sheet as a liability. Now, there were situations, as I said, where there was no deficit on the balance sheet, and increasingly actuaries, and I know in some sectors this is very prevalent, the actuaries are identifying the deficit on an employer-by-employer basis, and of course that deficit has to go on the employer's balance sheet. This exposure draft, and now this amendment to the standard, purely deals with the transitional issue. How do you go from a situation where you've got no share of deficit on your balance sheet to a situation when you do? Well, mostly it's about what it's not. This is not a prior period adjustment of any. It's not a correction of an error. This is something that gets dealt with in the period in which you get that information and you know that the deficit exists, and you don't put it through the P&L and you don't treat it as a reserve movement. The final decision was that it was treated as a movement through the OCI, the statement of other comprehensive income. So you created the liability on the balance sheet and you put the movement through the OCI. I have been talking about things as if pension schemes are only in deficit. I do realise that very occasionally they are in surplus, but I'm trying to live in the real world here. Now, we didn't talk about this last year. The multi-employer stuff, that's all in the notes in quarter two. This is in these notes for quarter one of 2020. And I want to talk about the changes for the interest rate benchmark reform. Now, this is a little bit niche. I suspect this is even nicher than dealing with multi-employer defined benefit pension schemes. What it is when you're dealing with hedge accounting. So if you are hedge accounting for financial instruments, and as part of that hedge accounting process, LIBOR is involved. I mean, it could be the hedged instrument has a relationship with LIBOR. It could be the hedging instrument has a relationship with LIBOR. Or it could be a situation where to hedge account, you need to use an imaginary instrument with LIBOR. Those of you who are doing it will know what I'm talking about. Now, the problem here is, and you'll see on my slide, it says LIBOR is unlikely to exist from 2021. Well, that's the language the exposure draft uses. I think nowadays the language is much clearer. LIBOR is not going to exist in 2021. And of course, this is all down to the LIBOR scandal, isn't it? The manipulation of it. People have lost faith in it. And the city regulators are trying to come up with a better measure. A more trusted measure of that sort of risk-free rate of interest. And when they do, that will replace LIBOR effectively. But of course, we've got contracts and we've got hedging arrangements that use LIBOR. And the issue with hedge accounting is that when you are doing your predictions into the future, your future cash flows, uncertainty is not your friend. When there's lots of uncertainty about whether this hedging relationship matches, then you have to discontinue hedge accounting. And long story short here in this exposure draft is don't when it really is in relation to LIBOR. See it through just to keep the hedge accounting going until we know what replaces LIBOR. Again, bit of a niche topic, and if all of that was gobbledygook, well, there you go. Let's talk about the other change. Now, FRS 101, this is periodically changed. I mean, this has had to be amended because the latest changes to IFRS, so we've amended FRS 101. I'm not sure the details matter very much, of course, because we've got new IFRS standards, so we've got new disclosure requirements, we've got new exemptions. Some things to watch out for: insurance companies can't use FRS 101. That doesn't work. That's a change within this review here. In any event, let me just use this as an opportunity to remind you what FRS 101 is, just in case you've never come across this standard. It's like a hybrid between IFRS and UK GAAP, and it tends to be very useful within IFRS adopting groups where you've got a UK subsidiary. I mean, particularly for smaller companies, IFRS is really a hammer to crack a nut. It's massively over the top, huge amounts of disclosures. But you can understand why group finance directors overseas want UK subs to use IFRS to make the consolidation more straightforward, to be consistent with other members of the group. And FRS 101 does that, because FRS 101 uses consistent recognition and measurement requirements to IFRS. IFRS 16, 15, all of that will be in FRS 101 in terms of the numbers. So you've got completely consistent numbers, but it exempts you from 90% of the disclosures. So FRS 101 has got that use. It is worth just mentioning that for really small companies, sometimes FRS 102 can work just as well. It sometimes takes a little bit of convincing of the directors of that fact. FRS 102 is a fairly convergent standard, and the numbers can be the same as IFRS. And of course, for small companies, FRS 102 gives you scads of small company exemptions, which can be really very valuable. 101 doesn't have those. So that's what 101 is for. If you want more information on 101, have a look at the standard. This isn't a standard we tend to concentrate on very much because it is, again, pretty niche, but just to put you on alert that there have been those changes. If you do use FRS 101, of course there are certain companies that will supply you with example disclosure checklists. There are model accounts that you can download from all the major accountancy firms, and there is software that will supply templates. I mean, some of the well-known accounts preparation software do have a good FRS 101 template that you can use. Okay, that's the roundup of stuff that's nothing to do with the FRS 102 Triennial Review, and as you can see, there's not very much of it. Thank you for listening.